Hey everyone, this is Unit 4, Macroeconomics, and it's an FRQ, just kind of made it up. And there's the question, should be posted on Google, and it should be posted on YouTube underneath the video. And here's what we did first. The first part of this question, you have part 1 and you have part 2. Part 1 is the fiscal portion of a recession, and part 2 is a monetary portion. So the first one, here's how I answered it. You have a $40 billion recession. It says to draw an aggregate demand, aggregate supply curve. So we've got average price level, we've got real GDP, SRAS, aggregate demand, long run aggregate supply with full employment, and this is our current recession. All points for that answer. It says, name one fiscal policy to combat a recession. I chose increase government spending. You could have chose decrease in taxes. Then it says if the MPC is 0.8, then you've got to figure out your government spending multiplier, which is 1 over the MPS. So if the MPC is 0.8, the MPS is 0.2. So 1 over the MPS, which is 5, will give you the government spending multiplier. And once I get that, I take the $40 billion and I divide that by the multiplier, and I get 8 billion. So government spending must increase by 8 billion. That would be all correct responses. Take a look at it again if you want to go over it. Now the second part gives the same scenario, $40 billion recession, and instead of a fiscal policy, it asks for a monetary policy. So what type of monetary policy would be used, expansionary or contractionary? You should have easily said expansionary, okay, for 2D. Then it says to name, one open market operation. This might have thrown some of you off the language. An open market operation is either one of two things. Yes, it's a monetary policy, but it's either buying or it's selling bonds. It means what's being bought and sold on the open market, and they're referring to the bond market. So an open market operation, OMO, in this case, when there's expansionary policy, you buy bonds, and that's it. All you have to say is buy bonds. For the third part, it says, for part F, it says to draw what happens to the money market account as a result of buying bonds. It doesn't give you any specific numbers. It just says what generally happens to the money market. Well, if you buy bonds, that's literally the Fed is injecting money into banks, into their bank reserves. And so the money supply will increase. You have quantity of, sorry, I'll go over the graph points first. You have the quantity of money, nominal interest rate, money supply vertical, money demand going down, downward sloping. So money supply shifts to the right, which then lowers the interest rate from interest rate 1 to interest rate 2. And that's it. That's all you really have to do to have full credit there. For G, the question says, explain how the change in 2F would help the economy get out of the recession. Well, you have to understand that when interest rates go down, investment is going to increase. And so you could say buying bonds, I just use these acronyms, increases money supply, therefore decreases nominal interest rate, which is what you showed, right? Decrease over here. And because of that, it increases overall investment, or you could say increases investment in capital stock, which then increases aggregate demand, and that's your explanation. Not a usual explanation, right? Not like a history course, right? This is your explanation. There's a whole bunch of acronyms here, but that's what it is verbally. All right, please leave any comments in the questions in the comments below.